The US Federal Reserve has moved to increase interest rates to a 22-year high. It's risen from 5.25% to 5.5% in an effort to quash inflation. Joining us live now, Chief Market Strategist at InvestSMART, Evan Lucas. Evan, so I would have thought that they'd be coming down by now, but they're not. So are they at their peak yet?
The market believes they are. And why I sort of highlight that, this was expected. I mean, if you look at what was leading into it, the market had a 98.7% chance that this morning's rate rise was going to happen. So it was all done and dusted. What I want to point out is that what Powell, so Chairman Powell, was talking about in the aftermath is that they've still got a long way to go on inflation and that they're still not necessarily done, but that they are now data dependent. And if they're data dependent, the market took that straight away as signs that they're probably now at their peak. If you look at US inflation, it's at 3% and falling rapidly. It needs to get back to 2%. So considering that it was well and truly into the 8s, touching 9s in December last year, to be at 3% and still falling, the argument is there. You're also seeing a slowdown, but not a spike in employment in terms of where it is. It's slowing down, but unemployment's holding it where it should be. And overall, if you look at the inflation in services, that's also now starting to come off. So all arguments is that this morning was it. They are done in terms of this rate hiking cycle. As you said, 22-year high, highest has been since 2001, but that they are now in a sustained period of pause and all the way through probably till February next year. Their major meeting in 2024 is in March, and that's where we will probably start to get an indication of, as you said, a possible cut.
Okay, well, Evan, to us now, are we at the end? Are the rate hikes over?
Yeah, so that will be the next question. I mean, yesterday's inflation data, from my perspective, was as I hoped and expected, which was for the trim mean, so the core data, to be at 5.9%. We are probably also done. That's my view. And I think next Tuesday will be a pause. We will also be in an extended pause. The RBA over the last sort of 2 to 3 months has been at pains to make two things very clear. Number one, it has taken us 50 years to get to the employment level that we currently have, and they don't want to rock the boat on that. Number two is that they have gone slower than other banks for deliberate reasons, one around employment, but also around making sure that they can somehow keep a level of sustained movement going on in the economy. And that is why, with the inflation data where it is at the moment and where it's heading, next Tuesday should be a pause, and it probably will mean for the rest of this year it's a pause as well.
Okay. And then cuts, presumably.
Yeah. And that's a reasonable thing. I mean, if you look at all the data, if you take the 6 months inflation data this year alone and annualize it, we're actually running at 2.5%. So yes, we're running at 5.9, 6% on the headline right now. But for the inflation data of the 6 months we've just had, it's at 2.5. So that would mean the Feds and also the RBA have overdone their estimates on where inflation will be. The Feds by a year, the RBA by almost 18 months to 2 years. So there is every reason to be arguing that in 2024, if inflation's back in between band 2 and 3%, that rate cuts are definitely on the cards.
Okay. Evan Lucas, good to have you with us as always. We'll talk to you soon.